I see the tokenization market is growing massively, and every crypto exchanges, this was actually our thesis back in 2018, right? You cannot survive just trading shitcoins, right? You need to have assets that are fundamental securities, Bitcoin, derivatives of Bitcoin, and that's where the market is heading.
I think there's a lot of cognitive dissonance for crypto people who don't understand the way the market's heading, simply because they think you can spin up all these, shitcoins and other different non-securities, security type instruments and try to trade them around. Simply, there's digital capital and there's securities. I think a lot of the veteran crypto native individuals are starting to learn on the fly here that the market is concentrating around Bitcoin.
Digital credit is just the answer for Bitcoin for 90% of the population and 90% of corporations, in fact.
Hey everybody, Tyler Rowe here with the Bitcoin Treasuries.net roundtable. 2 weeks ago, Capital B became the first publicly listed Bitcoin treasury in Europe to have its shares tokenized on Liquid via Stoker. And 3 months ago, a former Uber exec launched BuckToken, a dollar savings token collateralized by Strategy's STRC that pays a 10% yield to non-US holders. And these are not unrelated stories. I'm here with Alexander Lizay, as always, from Capital B. I've got Dan Hillary from BuckToken and Ardam Naskar from Stoker. Welcome to the roundtable today, boys. I'm going to throw it over to Alex first here. So let's talk kind of macro and the state of play in the world right now. We had just a ceasefire announced between the U.S. and Iran. We're seeing assets pump all over the place. Bitcoin's price, we're at 71K today. So what's your take of the lay of the macro landscape? Is this a for real pump, or are we still just waiting for the macro headwinds to kind of die down, Alex?
Yeah, in my view, last year was the great securitization of Bitcoin, with the transformation of capital into digital capital and transformation of credit into digital credit. And this year is the year where it consolidates and where institutions are starting to get back in, and specifically that the bottom is in gold terms. And that's quite significant. And, there is a saying from the Rothschild family that you sell at the sound of the trumpets and you buy at the sound of the cannons. And I think the cannons had already been there when the war started in Iran. And you have seen that Bitcoin has significantly reacted to that. And there has been a return of volatility. There has been a return of plus 5%, plus 6, 7%, and in Bitcoin Treasury company land of 10 or 20% sometimes. And you can just see that after 6, 8, 9 months of bear market in the Bitcoin Treasury company space, that there is a lot of interest coming back. There is a lot of capital coming back. And everybody is just looking at how to take advantage of the next bull run, also knowing that, of course, you never know when there is a bottom, and that's why you need to buy every day, stay humble and stack sats. But in my view, there is a much bigger thing at play in the world right now. It's the imbalance between the deficits of the governments and the money that they can get in. And that balance is just growing by the day with the geopolitical conflicts and the shortages in terms of oil and the impacts that can have on inflation. And so immediately that can affect the purchasing power, the investable size of the savings of the people into assets such as Bitcoin. And so that's why you see a lot of volatility, and you need to brace your seats. It doesn't mean that it cannot be volatile both to the downside or the upside in the following months. But what matters is that the underlying thesis for Bitcoin, that it protects your savings over the long run against monetary inflation, is there. And that monetary inflation is inevitable, and that its potential is growing by the day with everything that we are seeing. And the ceasefire is another indication that we could go into the right direction in terms of assets that are currently treated as risk assets. And Bitcoin is currently in that bucket. Over time, it will be understood more and will evolve. But today, in my view, it just shows how one single announcement at Geopolitical has enormous effect on the Bitcoin markets. And it's just more opportunity for us at Capital B and all Bitcoin treasury companies to accumulate more Bitcoin and have a lot of volumes in the market, a lot of volumes in digital credit. And so, yeah, I would probably hand it off to Arnab to talk as well on the tokenization of the shares that we just did in that overall context of bear market to increase the accessibility of the share. And in my view, this is really underestimated, both on the digital credit side, and Dan will talk about that, I guess, but as well on even on the equity side, because if shares are accessible 24/7, accessible directly in Bitcoin, and in a future state potentially on exchanges as well on a broader size, I think it will be really transformational, and you will see a lot of new trading pairs starting. So really accelerating in my view. To you, Arnab, to talk more about tokenization.
Yeah, thank you. Thanks, Alexander, for this introduction. And thank you, Tyler, also for having me in this session. So it's a very interesting week. I think this market is changing. Like yesterday when I was going to bed, I'm based in Berlin. So I heard about the Trump's threat after a certain time frame. If issue is not solved and its civilization will be wiped out. Thankfully, when I woke up, this is not the case, which is quite positive, to be honest, in the current scenario. And also that Bitcoin is getting some volatility of that because global macro is volatile, right? And Bitcoin is not a different asset class. Stoker, just to give a kind of, for those people who doesn't know what Stoker is an asset tokenization platform. We are tokenizing financial assets like securities, like debt, equity, likes of those products. We are doing it from 2018, 8 years in the market. Have seen number of market cycles, bull bear, bit like two halving, I would say, that regard also have seen. And Stoker's main angle was tokenizing, first of all, Bitcoin aligned instruments, Bitcoin derivatives like tokenized Bitcoin mining hash rate with Blockstream mining, fixed income products that support Bitcoin miners, but also we tokenized Bitcoin treasury companies like Capital B, MicroStrategy. And we started actually in 2022. The first tokenization we did in that direction was with MicroStrategy shares. We tokenized and we issued a product called CMSTR. And when we tokenize a Stoker, is always a question that we consider is why we tokenize something and why it need to be tokenized, right? For Bitcoin treasury, we see a very strong angle. And this comes because every Bitcoin treasury is kind of, the shares are denominated in dollar value, but also denominated in BTC value. It's BTC per share. But in current traditional market, you cannot trade the shares on a BTC basis. But as we know, Bitcoin is the most volatile, sometimes mostly over the weekend where the liquidity is low. And that's a good time for trading those treasury companies, but you cannot do it in the current stock market. So we started this initiative in 2022, tokenizing MicroStrategy. And we saw on a side swap kind of a DEX platform where people were peer-to-peer trading this tokenized MicroStrategy. And certain weekends we saw volume went to around 500K size, which is significant on a DEX platform. Continuing that initiative, we tokenize now Capital B shares also from our vehicle that is supporting the tokenization. And this came live just around the Easter, so just before the Easter holidays, I would say. And it's a product that we are seeing quite some interest in the market right now.
Dan, I'm going to throw it over to you here. We've seen Michael Saylor just pounding away with his digital credit offering.
If you're trying to get to the top of BitcoinTreasuries.net, you need institutional infrastructure to match. BitGo is the digital asset backbone trusted by thousands of institutions worldwide. Why? It offers regulated custody, OTC trading, financing, and settlement all under one roof. They're now a publicly traded company on the New York Stock Exchange and hold a federally chartered national bank license from the OCC. For treasury companies, it's a must call. This is the infrastructure layer that really matters. Learn more at bitgo.com. It's the best kept secret known by every true Bitcoin OG. CoinKite has been building the gold standard in private key security for years, and they just raised the bar again. The cold card queue is an absolute powerhouse for serious Bitcoin treasuries. We're talking a full QWERTY keyboard, air gap protections, and it's built for maximum security. The brand new cold card MK5, it has a massive Gorilla Glass screen and new NFC functionality for an even more seamless experience. So if your business is large or small, there's a cold card for you. Head to store.coinkite.com and use the code 6BT at checkout for 6% off. Stop cutting corners on your Bitcoin treasury. You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
He's finally had this iPhone moment of launching Stretch, which has that monthly dividend, a variable dividend rate. You're building, you're part of the BuckToken team who's collateralizing Stretch for the rest of the world. You've been so bullish. I've seen you on the True North calls. I've seen you on your own streams, Dan, talking about how important Stretch has been. But has it even surprised you at how quickly Stretch has taken off and it's being absorbed by the marketplace, given it's less than a year old?
Thanks, Tyler. Yeah, I didn't expect Stretch to take off as quickly as it did, simply because the other preferred equities didn't gain as much traction as I thought they would have during the 12 months after the initial launch of STRK, the convertible preferred, the first preferred strategy launched. Obviously, what was different with STRC was simply the price stability mechanism, which is a function of STRC being the first monthly variable rate preferred dividend stock with a shelf registration and an ATM on it. Those two innovations are what allows Stretch to maintain its $100 par based on market demand. So, prior to Stretch, all the different instruments in the market were simply priced at a spread above SOFR. And that was the mechanism by which these preferred equities and some of these money market funds, not really money market funds, but some mortgage-backed REITs and other dividend-paying securities were trying to maintain a par value or a stable value. They benchmark off SOFR because as SOFR changed, their dividend rate would change, but that would ultimately, hopefully, stabilize their price. The innovation with STRC is that it uses the trailing 30-day volume-weighted average price of the stock to determine the increment of change in the dividend rate. And so this is obviously massively effective, and clearly the market wants something with low volatility as opposed to kind of long duration, which we're seeing in the other preferreds. The other preferreds are long duration yield, right? Stretch is short duration yield, but it has stable principle, and that's what the market clearly is indicating that it wants.
We've seen the dividend rate be increased by Saylor over these several months, when it was trading below par. And now, given the last couple months have been, really close to par, down slightly after the ex-dividend date. Do you think it's going to be difficult for him to lower the interest rate on STRC? I mean, it's yet to see really what that environment looks like, Dan. If I'm sitting in Saylor's seat and Stretch demand is increasing, it's like I just want to hammer the ATM as much as possible and then raise funds to cover it. How's he gonna balance that tension, Dan?
Look, I think that's a really good question. And obviously, this month we saw that Saylor didn't increase the dividend rate. As per the mandate, the Stretch's volume-weighted average trading price over the last 30 days was between 99 and 100. Therefore, he didn't increase the dividend rate. So I think his mandate is going to be to stick very religiously to the guidance he set forth for how he manages the dividend. By that same token, he likely won't be decreasing the interest rate for a little while because he's able to so dynamically issue more stock at $100 and keep the price pegged at 100. I don't think we'll see a 30-day period of time where the price of Stretch is above 101 simply because he's so effective with the ATM. Now, that being said, I do think a decrease in the dividend rate will be a massive signal to the market that there is pretty much unlimited demand for STRC. So I actually think of it as an interestingly bullish scenario, because once there's so much demand for STRC that they can't ATM enough STRC to keep the price down below 100, he will have to then use the dividend decrease mechanism via the price trading up in order to curb some of the demand. So that will be an interesting development, like you're saying.
Yeah, it'll be really interesting to watch, and I think in a bull market, I think we do see that, because there's some people say in a bull market we may not see stretch have as much demand, but I think the more eyeballs that come on Bitcoin, there's just going to be all kinds of money being absorbed by strategy through its digital credit products and on the common. Alex, when you heard that Dan and the team with BuckToken were collateralizing STRC, for the masses, for people who maybe can't access STRC in a brokerage account, what were your initial reactions to that? And do you think we're going to see more of this in the future?
Yes, I think this is definitely the future. It's definitely even more impressive the speed at which Stretch has been tokenized after the speed at which Stretch gained that much of product market fit. The tokenization of it was extremely fast. If you compare that to the pace of tokenization of other traditional financial instruments, this is typically not really market driven. You have a big institution that does some kind of a proof of concept and tokenizes a traditional market fund. And then after 3 years, you have BlackRock that launches the tokenized money market fund. But typically it took years to tokenize traditional financial assets. And here you see really the meaning of digital credit. The meaning is not only that it's backed by Bitcoin, it's also that it is fit for purpose for tokenization directly as well, because of the monthly payment, because of the retail participation, because of course the availability on multiple platforms and so on. But the product is also responding to that huge demand in the digital world for stable coins. And historically, stablecoins don't pay a dividend. And in that respect, you get a form of a stablecoin value with the par. And of course, that's a risk because you don't have a certainty. You have some level of trust to Bitcoin and its trajectory and to the company. Definitely, it's a security. But you also know that it's completely collateralized in a way that is not even comparable and to any other financial instrument. And Feng Li just mentioned in a recent interview, if you consider the amounts that have been invested into Stretch in billions and billions, you could argue, when you compare that to the launch of other consumer products like the iPhones and other such products, and typically it takes a year to generate billions of revenue. So here it's not revenue, of course, but it is a capital raise with no dilution. And it is to acquire Bitcoin, and it is in a matter of 6 to 8 months. And so that's extremely significant. And so the tokenization is definitely not a surprise, but the speed at which it happens is extremely impressive. And I would like actually to ask you, Dan, a question around the environment for tokenization around Stretch and the differentiation between the different platforms that engage in the tokenization of Stretch, because it's already like 4 that have launched initiatives. And I would like to understand how Buck positions and what are the key differences in your view to take into account.
Sure, Alexander. Yeah, that was a great overview of the kind of the tokenization and how Stretch is being integrated into the stablecoin market. So for anyone listening that doesn't understand what we're talking about, Buck is we call it a savings coin. It's effectively it's a savings coin backed by STRC. So we pay out 10% yield annually to holders, and the way we do it is via value accrual or yield stream, which I'll talk about in a second. So again, I like to think of a stable coin as your checkings account, right? You send money, you transact value, lots of liquidity, very fast into settlement. And Buck backed by STRC is your savings account. It's your high yield savings account where you want to protect your wealth and grow your wealth, right? Obviously, this is all aside from Bitcoin. I'm a Bitcoin maximalist, so that's digital capital. Okay, so the real question, like you were asking, Alexander, is how do you tokenize this STRC? How do you create the perfect product on chain in the crypto market backed by STRC? And that's a question that seems kind of like there would be an easy answer, but it took us months and months of development to figure out exactly how to do it. Other products in the market have come out with these different types of token architecture where there's two tokens, right? There's a stable coin, then you stake the stable coin and you get the backing of STRC. It's all very complicated. It's difficult to provide enough liquidity, and liquidity is one of the most important things when mitigating risk for any of these tokens, right? Why is Tether and Circle, some of the two biggest stablecoin issuers, why are they thought of as the most, credit worthy or safe? It's a two-part thing. One, they have the longest track record. They have strong collateral backing and strong attestation. And then they also have really, really strong liquidity across all the markets. You can swap in and out at any time. So liquidity is massively important for any sort of market. Now, with these other products, you have two tokens, which have two different types of liquidity. They have staking, they have lockup periods. It's very complicated. With Buck, we decided to make it super simple and really, really user-friendly for anyone that wants to get STRC-backed exposure. And the way we do this is we have a single token, that being Buck. It starts at $1. Today, we just launched our upgrade, so it starts at $1, and it goes up a little bit every day and at a 10% annualized rate. So for example, if I were to buy $1 of Buck today, in a year's time, if STRC was still trading at $100, my $1 of Buck would be worth $1.10. So that's a tax advantage manner to get all the savings yield from STRC directly on chain. And I think that's a big unlock for the $300 billion stablecoin market and for the 4 billion people worldwide that don't have access to a US brokerage account to hold STRC.
Yeah, really, really big unlock there. And I'd like to come to you, Arnab, and you guys have on your platform at Stoker tokenized, over $1 billion of assets. Is that adoption accelerating, and where do you see the demand coming in the next few years?
So we started looking into the Bitcoin mining segment in, I would say, 2021. And primary user base for us was family offices who wanted to buy or mine Bitcoin, but they do not want to go into the complexities of, finding the right ASICs, the right energy infrastructure, managing the downtime, managing all this demand response program and all these things, right? Because they are eager to invest few $100K or few $1 million, but they don't want to have a team that is managing that. And what we provided with the Blockstream mining node, which is a securitized hash rate, is you buy a product that provides a fixed hash rate for a duration of 3 years or 4 years, and whatever Bitcoin is mined, you get at maturity. Very simple for people to understand. These are securities with the ISIN number, happen to be in tokenized format on Liquid, so you can hold the securities in the same wallet where you can hold your Bitcoin. And this product paid out 80 million in Bitcoin 2024, outperformed Bitcoin by 32% over a 3-year period. It's 32 over a 3-year period. It became quite interesting for a lot of people. And when we launched the second iteration, it went to closer to $1 billion. Now, the users that were buying these products are family offices, ultra high net worth investors, hedge funds, likes of those people. Last year onward, we started looking into high yield product. And there we're looking into money market kind of products, but also, as Dan mentioned, and this is where it is interesting happening, right? A lot of asset managers still cannot buy Bitcoin because of the Basel requirements and all these things. But on the other side, a lot of family offices still, hey, Bitcoin is great, but I don't want to go into the volatility. And Stretch is, in that sense, a very innovative product because those family offices or asset managers understand a fixed income product. 11.5% fixed income product issued by a publicly listed company, which has 20 plus years track record in the capital market, makes a lot of sense to them. So we are seeing, actually, this is last year we issued some products, which is a fixed income product collateralized by the hash rate, providing 20% annualized yield. And quite some hedge funds actually bought that instrument. We are also seeing more demand of fixed income side, and that was, like I would say, between mid-teens return to 20%. That's kind of the range people are looking for, because in the current macro environment, fixed income products much more in the asset-backed securities kind of products. We are seeing much more in high demand. But we definitely also see interest of, and this is what I see as opportunity coming in, is Stretch is a dollar basis product, but there is also demand for euro basis similar products. And the market is there, right? I think this market is getting developed. And what we also see, that demand of these tokenized assets also will be on exchanges like Bitfinex Securities and likes of them, because Bitfinex Securities is a secondaries trading venue of Bitfinex where you can trade securities, and they have a license to trade securities. And they have a huge Bitcoin user base. Now imagine if you bring those treasury products over there and you enable a Bitcoin trading pair over there, you can generate some interesting alphas if you're trading against Bitcoin. This is really exciting for us. This is what we are trying to build, and we are trying to create effectively the infrastructure on which the tokenized securities can be issued in a regulated way for the market to interact. So we are issuing those securities in a wrapped version from a securitization vehicle, which is bankruptcy remote, which is tax transparent, and all these things. The investors get the benefit. So they get the institutional structure exposure, but it's a crypto asset, so you can interact with a blockchain wallet or P2P basis.
Yeah, really cool. Obviously the demand for these products and Bitcoin-backed products, companies, equities, digital credit is insatiable and incredibly widespread. So, it's like the failings of the traditional finance market are the gain of the Bitcoin ecosystem. And I think that's just so bullish for Bitcoin and for equities, digital credit, all backed by Bitcoin. Dan, I want to come back to you. I was reading a tweet that you put out that you said you're arguing that Morgan Stanley's new ETF that just launched is going to be as important as all the other Bitcoin ETFs combined. That's a cool take, and I don't think it's far from the truth at all, Dan. At Strategy World, we had Amy Oldenburg there from Morgan Stanley talking about, that this just being the beginning for Morgan Stanley coming into the Bitcoin and the broader crypto space. How do you see MSBT as a disruption, and is the competition on for real for these traditional finance firms having competing ETFs now?
Look, I put out that tweet specifically because I do, it's one of the first instances where a large broker dealer now has a competitive ETF, not only a competitive ETF, but an ETF that beats the fees across the entire market. So obviously this is the lowest fee ETF by 50% relative to all the other Bitcoin ETFs. Plus they have diversified custody between Coinbase, BNY Mellon, and a third custodian that I forget the name of. But this is a massively important development in the Bitcoin market and the ETF market, because there's massive concentration within Coinbase for ETF custody. And I think that's one of the reasons why the Fidelity ETF has been as attractive as it has been, is because it's the only way for people to get diversified custody from the other ETF providers. So for those reasons, I think this will be a massive unlock, and anyone trading this stuff in their IRAs will probably switch into the lower fee structure. And then thinking about the price action over the last 6 to 10 months, there's a strong likelihood that people are actually going to tax loss harvest by exiting some of their ETF positions and entering into this lower fee ETF, because Bitcoin's still considered a commodity, and you can tax loss harvest by switching between ETFs. It's a gray area, but you technically can.
Yeah, no, that's a good point I hadn't really thought of yet. And it will be interesting to see how much capital rotates into this. Like you said, they're leading the charge with a 14 basis point fee. And I think it's going to be a race kind of to the bottom on fees now. BlackRock's going to have to kind of make an adjustment here or leave a lot of money on the table. If you're building or managing a Bitcoin treasury, you need institutional infrastructure to match. BitGo is the digital asset backbone trusted by thousands of institutions worldwide, offering regulated custody, OTC trading, financing, and settlement all under one roof. They're now a publicly traded company on the NYSE and hold a federally chartered national bank license from the OCC. For Bitcoin treasury companies, this is the infrastructure layer that matters. Learn more at bitgo.com. CoinKite has been building the gold standard in Bitcoin private key security for years, and they just raised the bar again. The brand new Coldcard MK5 brings a massive Gorilla Glass screen and new NFC functionality for a more seamless experience. The Coldcard Q is an absolute powerhouse for serious Bitcoiners, with a full QWERTY keyboard, air-gapped, and built for maximum security. Whatever your setup, executive, Bitcoiner, Bitcoin Treasury, there's a Coldcard for you. Head to store.coinkite.com and use code 6BT at checkout for 6% off.
The dip is here, and with it, you might be thinking, is it time for me to borrow against my Bitcoin? Enter Arch Lending. They're building the most transparent borrowing experience in crypto. We're talking industry-leading rates from 8.49% when you borrow against BTC, and you receive USD within minutes. Your assets stay protected with qualified custody. There's no rehypothecation, and verifiable segregated addresses are used always. As your collateral grows, you can unlock more liquidity, adjust your line anytime, and extend your term with a single click. And with 24/7 white glove support, you're never going to feel like you're on your own. Arch Lending, simple terms, public pricing, market leading rates at every size. You can learn more at archlending.com.
Alex, how do you think about, a company like Morgan Stanley coming into the space and, bringing on their assets under management, of course, and they're just going to attract more capital to the space. Traditional finance, as you've told me on the roundtable several times, is already here. Investment bankers, you're talking with them all the time. Are these more bullish signals for Bitcoin and Bitcoin Treasury companies?
Yes, it is structurally extremely important. In fact, it's one of the most important aspects of the developments that we are seeing, because it's not only that Morgan Stanley is launching an ETF, is that tens of thousands of their employees are going to be talking about BTC to all of their clientele. And these wealth advisors and employees are also themselves investors. And they will be mandated to learn about Bitcoin and to listen to the podcasts and to read the research. And you can already see what the effects have been when institutions start to really understand Bitcoin. And you see it at Fidelity. They are really unlocking a lot of doors, and for a lot of years already, but it has a lot of effects, and it becomes the most profitable business line within those institutions. And we were talking about this previously for the investment banks, that their investment bank in charge of raising capital for strategy and for other Bitcoin treasury companies has been the most profitable part. And now you see, and we had already seen that, of course, with the profitability gained by BlackRock with the Bitcoin ETF. And now this is significant because it is the first time in the history of ETFs that you have a clear winner in the space of one asset of a specific ETF with BlackRock, but a new bank wants to launch its own ETF with a lower fee, even if there is a main player in the space, because it has become a branding issue for them. Because if they don't move, they not only lose the portion of the assets of their client dedicated to Bitcoin, they lose the client itself with the whole portfolio, because the client is saying, look, if you are not able to support Bitcoin yourself, I might as well go for my entire portfolio with this other player over time. And this becomes of strategic importance for those institutions. And when Michael says that Bitcoin has won and is recognized as digital capital, and that this is really advancing at a scale that is not realized yet, he means it, because he's in those discussions. And from the European perspective, we can see those effects as well, because it's really influencing the leadership of the banks to see that, yes, you have BlackRock, and then they say, oh, but it's only BlackRock and Fidelity and X and Y and Z. And then it's Vanguard that opens access to the BlackRock ETF. And then it's Morgan Stanley that decides to launch their own. And if it is successful, it will mean for issuers over in Europe that they can not be the first, they can not be the second or the third or the 10th. Even if they are the 12th, it will work. So I think it's really substantial. And this demand, once an investor has started to invest in Bitcoin in a securitized format, it is not 2 steps away, but it's now 1 step away from converting that ETF exposure to a Bitcoin Treasury company exposure, or to adding more to the position in the form of digital credit. And then, in my view, it is just showing that, the chart of the assets in the world of the 1 quadrillion of assets. We used to think that this would be replacing over time, that Bitcoin would eat over assets. It is true, but it is also true that in parallel, there you had just new asset classes being created around Bitcoin that not only replace the other ones, but create new asset classes of their own. For example, digital credit, you cannot really say that it is eating the preferred stock market. It was very small, but it is creating a new category like Bitcoin. It didn't exist before, and it's $2 trillion. And you create digital credit, and it will soon be $100 billion asset class in and of itself. And strategy, Bitcoin Treasury company, will probably go towards 1 trillion. And it's just going so fast that institutions adapt, and it's becoming a strategy of strategic importance. And this is the perfect illustration.
Yeah, it is growing so fast. And Arnab, I'll bring you back on this. You're talking with people who are building out, like you said, those products that are going to be in other markets other than the United States. We've seen digital credit have great success here. We've seen it being tokenized already. How close are we to more digital credit being offered throughout the world? I'm sure Strategy is going to be, working more at this. Of course, they have their STRE product, but to seeing something like Stretch rolled out across the globe, I think it's just bullish. How close is it, Arnab?
I think this is kind of how I see effectively. If the stablecoin market grows, the tokenization market will grow, right? And we are talking around right now 300 billion plus stablecoin market, which can cross over $1 trillion with all this market structure bill and the discussion about the US stablecoins and all these things. Because what stablecoins provide, the US dollar denominated stablecoins provide, is access to dollar in emerging economies, right? Now, when you give access to dollar, they will look for yield to the dollar, right? Now, imagine a Latin country, somebody is trying to get access to a dollar. They have to take a lot of haircut to get access. And that's what Tether effectively enabled them, is access dollar without losing a lot of value on those, peer-to-peer kind of one human-to-human black market transactions, right? Now, once they access those stable coins, they would like to generate a yield. The local banks are not providing that yield, right? Where they will park their stable coins. And there comes this kind of fixed income product like Stretch, or maybe some other version of Stretch that will come, right? In different currencies, different maturities, different segment risk-wise, right? That's a huge market. That's a massive market. So effectively what you're giving is you're giving a banking access to them, or savings bank access to them in their wallet, and they get exposure without going through the loops of going through the banking onboarding and all these kind of things. This market is very hard to project, but it's massive, to be honest. Like, it's $1 trillion plus market we're talking, right? It is where actually what we're really doing is using the store of value of Bitcoin and enabling an asset that people understand. They don't need to get scared about the volatility, but they effectively will bring a lot of people into Bitcoin. This is what stable coins, I think, bring people to Bitcoin more than fiat brings people to Bitcoin. The same way, stablecoin will bring more people to this kind of fixed income products, and that will lead them to Bitcoin because they will have more and more comfortability on Bitcoin as an asset class.
Yeah, makes a lot of sense, and I'm definitely bullish on that for sure. Dan, I'm looking at the Stretch tracker that we've got going at BitcoinTreasuries.net, and it looks like we've already got 170 plus daily volume on Stretch, and it's been trading at par above pretty much the whole time. Saylor's been able to buy easily over 1,000 Bitcoin today. I thought this was going to take seasoning, like, Fong has always talked about at Strategy, like Matt Cole's talked about with Strive, that these products are going to take some time to season. To see we're over $5 billion in AUM on Stretch. You've said this is headed to $15 billion of total market cap sooner than later. How is this happening so quickly, Dan? And what's it going to look like once bigger funds are able to allocate to this?
Yeah, I think there's two lines of thinking here. One is there's a really big buyer on the other end of stretch right now that loves it at 100 and loves it below 100. I also think there's also maybe hedge funds, right? Not really institutional investors, more hedge funds with very, very expansive mandates that love the arbitrage of buying stretch below 100. So I don't know exactly who is driving this price action, but clearly there's strong demand below 100, and I don't see any reason why that will stop in the near term.
Yeah, if if it is hedge funds, doing an arbitrage play, is there a risk that a lot of that capital drains out? Are you concerned there? And how would Saylor manage it? Only being able to maybe increase the dividend 25 basis points per month.
Yeah, and I think the dividend really changed the game. So obviously with MSTR over the past year and a half, we've gone through these very cyclical periods of time where the prices run aggressively and then the prices dive aggressively. And that's largely been a function of the ATM issuance and how shares get issued into the market. The fact that the cost of borrow on MSTR is very, very cheap because there's a lot of shares in the market, these are all accretive transactions, but they do create unique capital dynamics. Stretch is a completely new beast simply because it offers a USD denominated yield. So the cost of borrow of Stretch is very, very expensive considering the high yield payments. So I think it's going to be difficult. It's difficult to see why it would depeg for significant periods of time unless there's real jeopardy in terms of the credit risk of strategy. And if you're a long-term bull on Bitcoin, then that's unlikely in the near term or really long-term for that matter.
Yeah. Thinking about credit risk, Alex, as we're going to see more Bitcoin treasuries move towards this digital credit model. You've expressed how innovative it is and how attractive it is in different capital markets. Do you think this makes you more attractive, a Bitcoin treasury company, by having this preferred model of amplification rather than traditional debt or convertible notes or other types of financing? Do you think rating agencies are going to be able to wrap their mind around it, or does it even matter whether or not rating agencies understand the digital credit model?
So there are different questions there. The first one is how does that change the perception of a Bitcoin treasury company by investors or by large institutions? The second one is how does that shape the potential ratings in the future? My understanding in terms of the ratings is that they are going probably to be the last to move, or they will be very gradual in how they move, because they don't want to give the impression that they would have acted before the market. And so they will just follow the market. What I think will change is that at some point they will take into account the Bitcoin, because it's just completely unlogical to not take into account the Bitcoin of strategy when assessing the credit risk of strategy. It's just completely nonsensical. So I think that will change. But then they will apply probably a lot of buffers, and they will, apply a reduction of percentage and these kind of things. But they will be quite cautious, in my view, over time and very gradual. But I think something that people don't see for now is that the digital credit model completely changes how the public recognizes how a Bitcoin treasury company can generate value over time for its shareholders, and how traditional finance and traditional media understand what we are doing. It used to be 1 year ago that I was asked, what is the point of capital B if it is just buying Bitcoin? And you could talk about the potential for increase of Bitcoin per share, and how you could innovate in the capital markets, and how you could issue financial instruments of different kinds, and the Bitcoin convertible bonds, and how strategy was eating those markets in the US. But always the question remained, what is the end goal of all of those financings, let's say? And recently, I discovered through interviews and through discussions with traditional journalists that to the question of what is the purpose of a Bitcoin treasury company? If the answer is, well, the purpose is to digitally transform capital markets and to digitally transform how credit operates and to issue digital credit and to become the largest digital credit issuer in Europe, that made a lot of sense for them. And it was much easier to grasp from a traditional finance perspective of what is the business model of a company. And it used to be that then scenario where you would say that you are accumulating Bitcoin and you have operations. But now you say, yes, I have, of course, a very strong treasury of Bitcoin. I have a very strong operations. And I am targeting the North Star of the companies to become the largest digital credit issuer in a country, in a region. And that completely changes the game for a lot of traditional finance companies, analysts, and traditional media, because they have already understood in the past how digital transformations affect, impact, make traditional sectors evolve, and how those digital leaders emerge as the new leaders of the stock market. And when they understand that Bitcoin treasury companies that are focused on digital credit have the capacity to contribute to the digital transformation of the credit market, they understand directly. And when you mix that with the tokenization aspect, they totally get it. At least they get very curious. So I think that will get a lot of press and traditional finance into Bitcoin ultimately. And digital credit is just the answer for Bitcoin for 90% of the population and 90% of corporations, in fact.
I love it. I love it. We're coming up against our time here, but Arnab and Dan, I'll give you both a minute. Tell me what you're most bullish about and excited about in the coming year. Arnab, we'll start with you.
See, the tokenization market is growing massively, and every crypto exchanges, this was actually our thesis back in 2018, right? You cannot survive just trading shitcoins, right? You need to have assets that are fundamental securities, Bitcoin, derivatives of Bitcoin, and that's where the market is heading. So I see a huge market of a few hundred billions to 1 trillion of Bitcoin derivatives and structured products that includes stretch kind of yield products. And we will see from different markets, different flavor, different currencies. And this will be settled against stablecoins. That's I see as a huge market. And as Alexander mentioned, from Stoker's perspective, we are holding stretch right now in our balance sheet, right? Few years back, we wouldn't have hold because this kind of products didn't exist, right? So I see this will be a product every corporate treasurers globally will look into it. And this is where the market is heading.
I mean, Arnab pretty much summed it up. That was a really, really good summary of where I believe the market to be heading. I think there's a lot of cognitive dissonance for crypto people who don't understand the way the market's heading, simply because they think you can spin up all these, shit coins and other different non-securities, security type instruments and try to trade them around. Simply, there's digital capital and there's securities, and they're both, and then there's also securitized treasuries in the form of stable coins, all moving on chain. And that really the market's consolidating around the winning players, right? That being the equities markets, the U.S. Treasuries markets for payment, and then also Bitcoin as digital capital. And so I think a lot of the veteran crypto native individuals are starting to learn on the fly here that the market is concentrating around Bitcoin and the securitization of securities, not non-securities.
Amazing stuff. I love it. Guys, thanks so much for tuning in, all of you on X, YouTube. Thanks for watching, and be sure to catch the next roundtable for Alexander Lazay. Make sure you give him a follow on X. He's streaming all over the place, letting all you know what's happening with the European Bitcoin treasury market and what Capital B is doing. For Dan Hillary with BuckToken, and of course the MSTR True North, and Arnab from Stoker, I'm Tyler Rowe with BitcoinTreasuries.net. Have a great day.
Cheers.